pretty nicely done video that kind of summarizes some of these factors that we've seen. Momentum factor is a factor that's very difficult to capture if you were just trying to do that in a portfolio because of transaction costs, and we'll be studying transaction costs. But funds could be time the trades. So, for example, a fund manager says, I want to sell this stock, but it has positive momentum. The traders might, if they're given discretion to do that, might sell that over the next 3 month period or until the next earnings report comes out. So we have all these factors that we've studied, and the question is, what do we do with them? Well, first let's just revisit these factors. The best way of explaining these factors again is basically this paragraph. A highly diversified basket of stocks, equities, possesses an 80% or greater probability of outperforming the risk-free rate, which is basically U.S. Treasury 30-day notes, the return of that, over any given 20-year period of time. Now the actual percentage is actually higher than that, but I'm using 80% for all of these for a couple of reasons. One is so you don't have to learn a lot of different percentages in terms of your exam, but also some of these factors, as Larry Swedroe indicated, are not as strong as they were in the past. They've been reduced by about a third once they've been discovered. An alternative explanation of the market factor compares basically equity returns to corporate and government bonds as opposed to U.S. Treasury securities, 30-day U.S. Treasury securities. We have the size factor, small cap stocks outperforming large company stocks. Now, small cap stocks, somewhere between 50 million and $3 billion as of the first of this year. With the market decline, that the break point between large and small might change back to perhaps as low as $2 billion, which is what we've taught earlier in this course. Large company stocks, the break point between large and mid cap at the beginning of this year was about 12 billion. Again, that might decline back to around the 9 to 10 billion range that we used earlier. We have the price factor. Again, we're looking at valuation ratios here. That's how we compare one stock to the other. We're looking for inexpensive stocks as measured by one or more of these valuation ratios, price to book, which is very commonly used in the academic literature, and one of the best measures of value versus growth, or inexpensive versus expensive. Price sales is also a very useful one. Price earnings, yes, it's useful. We've just seen, however, earnings can fluctuate so much that sometimes you get distorted numbers when you're just looking at the price earnings of an index, for example. And we discussed the use of the Shiller PE10 ratio, which looks back and basically levelizes earnings out over 10 years. And that's a pretty strong predictive factor in terms of long term, over 10, 15 or longer years, what the future returns will be. Price to cash flow, also price to free cash flow is also a very good metric. Price dividends is often used. I wouldn't say often used, but sometimes used. But the problem is a lot of companies don't really issue dividends anymore, but it can be a pretty compelling metric. A lot of companies basically distribute cash back to investors through stock buybacks nowadays. The profitability factor is a newer factor, been around for less than a decade now in terms of a lot of academic literature suggesting it. Basically, stocks that generate large amounts of profits but don't have a lot of net assets to produce those profits. That's the metric we're looking at, and you can look at that by looking at gross profit ratio, net profit ratio, return on assets, some other metrics. But basically, high profitability stocks outperform low profitability stocks, or at least have a very significant probability of doing that over any 20-year period of time. And then we have, this is actually called the investment factor, and basically stocks that return the cash to investors tend to do better than companies that use that cash to invest in expanding production or new projects or going out and acquiring other companies. And then, of course, we have the momentum factor. We've discussed that a little bit. There's a lot of different academic research kind of indicating, how exactly to best use this. I like to say that stocks that have outperformed the overall market in the past 6 to 9 months are likely to continue to outperform the market over the next 3 months, or at least until the next quarterly earnings release. Also, we could take the reverse of that. Stocks that have underperformed the market over the last 6 to 9 months are likely to continue to underperform the overall market over the next 3 months or so. Now, this again is very hard to capture because of trading costs, which we'll study later. We have the term premium in bonds. Basically, long-term bonds have interest rate risk, and because of that, and also the fact that the longer the term of the bond, especially the corporate bonds and municipal bonds, the more likely that bond is to default over the course of its lifetime until its maturity. So we have a term premium here, and that should be rewarded through higher returns, and typically is, unless we have what's called the inverted yield curve. And then we have the default risk premium, which basically says, especially for corporate bonds, municipal bonds, if you have a lower rated bond, if the financial strength of that company is rated lower by credit ratings agencies such as Standard & Poor's, then you should get rewarded for the higher default risk that you're taking on there. And basically, we can divide up the bond universe between investment grade bonds and non-investment grade bonds. BB, B minus and above, up to AAA are investment grade bonds, and BB plus or lower are non-investment grades or junk bonds. So where are we heading with all this knowledge? We're going to be applying all of this as we construct portfolios. And we'll just take an example. This example uses returns and standard deviations over a period from 1995 to early 2017. So if we were to just build a typical portfolio, 40% 5-year Treasury notes, so an intermediate term bond with no default risk, the U.S. Treasury notes, and just large company stocks. Now, large company stocks constitute about 80% of the total market capitalization out there. So this is a fairly good indication of the overall market. The annualized returns of that were 8.3%, and the standard deviation, the measure of volatility of that portfolio, is 8.67. Now, if we were to take some of those large company stocks and tilt towards value, what we see is an increase in returns, and for at least for this period of time, we also see a slight increase in standard deviation. But what if we take those large company stocks and large cap value stocks and put them into micro caps, part of that, and part of that in small cap value? We're actually going to use funds here, fund dimensional funds advisors, to do that in terms of where this data came from. And what we find is a significant increase in returns because we're now using the small cap factor, and we see as well a higher standard deviation. So you might say, maybe we're a little bit more uncomfortable with a standard deviation, but what can we do to counter that? What if we do this? Let's increase the amount that's allocated to safe fixed income investments from 40% to 50%. Lower our allocations to all the other asset classes. What do we end up with? We end up with a standard deviation that's less than that of the original portfolio, and we ended up with the annualized returns that are more. And that's a concept that we'll be exploring in a lot more detail as we read the book by Larry Swedroe and others regarding reducing the risk of black swans. So, if we just look at some of the numbers, a growth of $1 to compare this, because when you're looking at annualized returns, sometimes you don't realize how significant the difference can be in terms of returns. You can see that $1 in the original portfolio grew over this period of time to $5.63, but about 77 cents more for the other one. A fairly significant increase in terms of the returns of the portfolio. So again, all of these concepts are going to be tested on your final exam because they are so important for you to have. Let's go on from here, and we'll get into some new concepts with new videos.